Welcome back to Laptop Trader. Again, this is Philip, Laptop Trader channel on YouTube at Laptop Trader. Welcome to our community. I'm here to share my experience and give back to the stock investing and trading community one video at a time. This video series is going to cover market cycles, stocks, ETFs, technical analysis, trade entry, trade management, risk management, and how to create confidence by putting the odds in your favor. Good luck. My email contact is laptoptraderphil@gmail.com. Caution, most stock traders lose money. Please protect yourself at all times. Nothing discussed in this video is trading or investing advice. This channel is for informational purposes only. Please seek qualified help if you need help investing. Start now by educating yourself on how markets work and finding out what is right for you. Invest in yourself and then invest in your markets. So this video is a revised video for 2025. This can be a very basic start to investing in stocks. If this is below you, or you feel this is not for you, or it's too basic for you, that's fine. This video is going to be meant for the brand new investor who really hasn't had much exposure to investing at all. So I'm going to cover where would I start, what are some benchmarks for investing, the basic vocabulary of investing or trading, how does money work, are there risks involved, I've got some recommended reading ideas at the end, and can I beat the market with trading? So intro, knowledge is power. However, too much knowledge or information is very confusing. In the information age, there is many times too much information, and this is where I started my investing journey, from a point of confusion. If you are like me and are not sure where to start, this may be the guide for you as a starting point. While it is true that there are many excellent books and authors on the subject of investing and trading, I never really felt confident until I started to see some returns from my work. After all, basic online search of how to invest in stocks returns a search of over 2.3 billion items. That is quite a lot of information to sort through, and even worse, if you need all of the answers before making a decision, known as analysis paralysis. You just become paralyzed with too much information. How to avoid information overload. Well, professional traders have a trading plan and an approach to quickly filter through information to get to a point to make a decision to enter or not enter a trade. For example, a day trader using a 15-minute time frame does not have all day to spend filtering through the last quarterly report of the company being considered as an investment. This is why most traders will use technical chart analysis as a go or no-go tool at that moment in time. Too much information leads to confusion and a state of fear and indecision. This indecision keeps us from moving forward toward our goals. By being focused, we can sort through the noise and the news and select what is correct for us and our plan. So our plan is our guide. Freedom makes a huge requirement of every human being. With freedom comes responsibility. So just start today. Start today with what you have and have a goal to be more and learn more. Because this isn't really talked about much in the investing or trading community, this is where my journey starts, and I think it should start for you too, and that's personal money management. Step one is to create and follow a personal or a household budget. It does not matter age or situation, or if you're single living at home or have a family of your own. I cannot stress how important this is. If you can't or won't do this step and are having problems of discipline with money, then you can stop here at step one until you can exercise some discipline to take control of your money and your life. If you can't manage your finances, then you won't be able to manage your investments or trades. And another word for a budget would be a spending plan. So we're going to create a spending plan for you. So this would be a basic budget outline or a spending plan. It just simply starts with income from your job or business, what you take home from your job or your business, whatever that amount is, doesn't matter. And then you're just going to list under that what you spend every month on housing, transportation, food, utilities, insurance, what you use on entertainment or going out to restaurants, daycare, any loan payments you have, such as car loans or credit card loans, any other expenses that you can think of. And then finally, you should have a line in there for investing for your future. If you don't have any left for investing, then you need to pay off your debts or earn more so you have some money to invest. And then finally, your total expenses should be less than your income. So you should have some money left over after that for investing. A fool and his money are soon parted. If you're still having trouble with step one, I would encourage you at this point to seek financial counseling and or a financial planner who you know and trust. In my experience, you will not have success in the financial markets without financial discipline. Step 2, start your plan. This to me was the exciting part after I was able to get past step 1, as I could now see my future open up to more abundance that was available to me. There were some basic steps or guidelines to follow would be: how much do I have in my budget for investing or trading? Does my employer offer a pension or tax advantage savings plan, such as a 401k? What are my investment choices? Based on my current income and lifestyle, what is a large amount of money? What is my knowledge of investing or trading from 0 to 10? So be honest with what you know and what you don't know. So how much money do I have to invest or trade? So most employees will contribute to the retirement between 10 to 20% of their income before taxes to a 401k plan for the future or a pension. This is tax advantaged and sometimes matched by your employer. Matching is like free money you didn't have to work for, so use it. If you don't have a workplace retirement plan, then you may need to upgrade your job skills, change employers, or make up your own retirement plan or say certified financial planner. So what are some of my investment choices that we have? I'm going to start small with stuff we've probably all heard of. I'm going to list these from least risk up to the more risky investments. So first, I think we've all heard of bank savings accounts or CD accounts at banks or money market funds or even treasury bills, government savings bonds, or assets labeled as fixed income, which generally equal low risk or low return. When it comes to these safe investments, we need to compare them to something. First, we must compare them to the historic inflation rate and the current inflation rate. We need to consider our risk to reward as measured by rate of return, or our ROI, our return on investment. So there's some economic benchmarks we need to understand as a comparison. When we use benchmarks for comparison, as everything economic is relative. ROI is generally measured in a percentage return, like 5% ROI. Investments such as bank savings, bank CDs, and money market accounts are considered safe and insured by the government. Generally, safe investments like savings accounts are considered low risk and low reward. Historically, the average inflation rate is between 3 to 4%. Inflation is like a hidden tax that subtracts from your investments and your money. If you have a 10% ROI and a 3% inflation rate, you effectively have a 7% return rate. At this time, we need to define inflation and interest rates and why they are important. A good source to look for current interest rates would be bankrate.com or maybe yahoofinance.com. Let's define inflation and inflation rates. Inflation, in a most basic definition, would be the rate of money or capital losing value over time. It is essentially the cost of the money supply. Many factors contribute to this inflation rate, but the most direct effect on inflation is the money supply and government spending. As the money supply increases, so does inflation. As a big spender like the government spends more than it takes in income taxes, inflation also increases. Other factors also contribute, such as uh, employee wages, consumer prices, and commodity prices, such as oil. General economic conditions also contribute to this formula, and this is why the Federal Reserve, or the Fed, is always monitoring the economy, interest rates, and the money supply. The historical benchmark is about 3.25% average per year. So this is our first number we need to exceed in order to break even on our investments. Now let's define interest or interest rates, and it's simply the cost of using someone else's money. For example, the bank wants to pay you, let's say, 0.06% to use your money and keep it safe, and wants to lend it out to someone looking to purchase a house at today's average rate of 4% for a mortgage. These are actually low compared to the last couple of years. These rates for the cost of money are set by the marketplace and the Federal Reserve, which controls the money supply and the rates at which the banks borrow money from the money supply. Another example would be auto loans, which vary greatly based on make and model of car and your credit score, and can be between, let's say, 0.9% up to over 20% per year. When you use a credit card, you are paying interest for using someone else's money or capital. From here on, we will refer to money as capital. Just remember, interest is the cost of capital. What are you willing to pay for it, or how much will you charge to use it? Now, with that base of knowledge, we can tie together interest rates, the rate of inflation, and investment rates with some basic math. The point here is not to be intimidated with complicated definitions, but just an understanding of how they affect you and your financial future. So, for example, if we can earn 10% in the stock market and inflation is at 4%, and we can avoid paying 15% interest on, let's say, new furniture, then we can stay ahead of our money losing value. Now, for another example, if we put our money in a safe bank savings account at a 3% return and inflation is at 3%, then we are only breaking even. Then, if we also use credit for purchases, we are falling behind in the money game by the rate of interest we are paying. This is why people say, I just can't get ahead, because they don't get enough of a return on their investment dollars to overcome market forces and their own spending. A few common sense things on interest rates, inflation, and savings. Well, you cannot really control them, so don't get hung up on these widely reported numbers. They are what they are. So let's focus on ourselves and set up a budget, including some money for investing. Put away a minimum of $1,000 in a savings account and preferably 6 months of expenses as an emergency cash fund, even if it earns little interest. Try to out-earn the historical inflation rate of just over 3%, which is not very difficult to do in an average total stock market mutual index fund. On average, the S&P 500 index since the 1920s has returned about 10.5% per year. So what can we control and what we cannot control? So stuff that's in our control, our source of income, right? Where we go to work, where is our business? What type of employer or what type of business do we work at? Amount of the income and our career choice is within our control. Spending habits and use of credit and money management. Our investment choices. How much we save, spend, or give to charity. Who we vote for. Our level of education. Who we associate with. Our money management and our budget. These are in our control. Things that are out of our control: inflation and interest rates, government policy pertaining to economics, stock market direction, and of course the weather. So, what are the risks of investing or not investing? I would argue that you're going to invest your life in something, whether you like it or not. What do I mean? You can invest in education or ignorance. You can invest in hard work and or college degrees in hard work. You can invest in welfare or not working. You can invest in being honest and productive and a good citizen, or dishonesty and criminality. Why not invest your time in stocks or real estate or even just a good job and earn a return on your time and your money? The risks are real whether you invest in a savings or CDs or stocks or bonds. You can earn a low return or you could try for a higher return. Either way, you risk not making enough capital return, or in some cases, risk the loss of capital in a bad investment. Individual stocks or companies are traditionally very risky if you don't use proper money management. Stock index funds are less risky and diversified across many companies, but when the market goes up, your fund should go up, and when the market goes down, your fund will generally follow the market to the downside. These are some of the risks. Bottom line is no risk, no reward. One thing you can do is put information on your side and make good choices. This is just a quick chart. I'm not going to go through it in detail. I did last year on this presentation, but I'm just going to leave this up here for maybe 10, 15, 20 seconds. You're welcome to screenshot it. It's just a chart that I made showing stuff that's zero risk on the bottom left corner up to higher risk but higher return types of investments, and anything in between. So all the way off the chart would be stuff like, maybe opening a winery if you don't know what you're doing, or opening a restaurant, or CDC, CDS stands for collateralized debt obligations, or MBS, which stands for mortgage-backed securities. Very bizarre investments. And then on the left side off the chart is stuff that returns a negative return or a negative investment, such as cars, furniture, electronics, clothing, jewelry, tattoos, payday loans, and stuff like that. So that's all I'm trying to show on that chart. It's just a graph. Let's wrap up this first section on the basics. Start to practice money management in your personal life and immediately set up a written budget with some dollars dedicated to investing or trading. Be intentional with your hard-earned money. Take advantage of your employer-sponsored savings plan, as it should be tax advantaged. You don't need a college-level economics course on the economy or interest or inflation. Just know the basics and understand your first goal should be to beat or outpace inflation. Interest is the cost of money, and the only question is, do you want to earn interest and returns on your money, or do you want to pay someone interest to use their money? Put interest and the numbers on your side and avoid high interest debt. Next page will list a few resources for you to study and research. I actually redid this page. So here's a few resources on investing. Google or online search of investing, or Yahoo Finance has a pretty good page too. Bankrate.com on current rates of interest. Investor.gov for excellent online calculators on compound interest. Investopedia.com, pretty good articles there. You could go to Vanguard.com or any fund company of your choice, and generally they will have investor education tabs and resources on their sites. You could also research online brokers like Schwab or Morgan Stanley or Robinhood and see which ones you like, as if you were to invest in stocks or ETFs or mutual funds. Research some investors that you admire or find successful, such as maybe somebody famous like Warren Buffett. Um, you go on YouTube for a presentation by Milton Friedman on inflation. He's kind of a famous economist from the 70s or 80s, but it's an old talk, but it's still, I believe, relevant today. Research how the Federal Reserve System works and why we need it or why we don't need it. Kind of an interesting. There's usually an interesting discussion around that in different circles. Depends who you kind of hang around on that topic. Finally, use caution of promises of outsized returns from promotions online. Unfortunately, there are a lot of scams out there promising extremely high returns with no risk and stuff like that. So good luck to you. Here's a few. Here's a page just I put together of some investing books to consider. Some of these are geared towards traders, and some are more for investors. I would say How to Make Money in Stocks. One Up on Wall Street would be more geared towards investing and buying individual stocks. Secrets for Profiting Bull and Bear Markets, Market Wizards, and Reminiscences of a Stock Operator, I would say would be more geared toward traders. If you have any questions, I do have other books on other reading lists I would recommend. And finally, you're welcome to contact me at laptoptraderphil@gmail.com, and I'm on YouTube at Laptop Trader, one word. Thank you for watching, liking, subscribing, and sharing this channel and making this channel a success over the past couple of years. Thank you, and good night.